If life insurance is so bad, then why do banks, national banks, own so much of it? Why is it that you're being told life insurance is bad when some of the institutions that have the highest level of trust in our country are just stockpiling as much cash value life insurance as possible? In this video, I'm going to walk you through why life insurance is being acquired at record paces by banks, some of the biggest banks in the world, in our country. But yet you're being told life insurance is a bad investment. Dave Ramsey, Suze, Orman is telling you life insurance isn't for you. I'm here to break that myth today. So remember to like, comment, share, subscribe to our channel, and let's dig right in. And let me start with some statistical data. So JP Morgan Chase, Bank of America, and Wells Fargo, as of December 31st of 2023, represented the three largest national banks in our country. So every so often they have to put out a report, and this report, I'm going to do it for JP Morgan, Bank of America, and Wells Fargo, lists their assets, their liabilities, and it breaks down every bit of what type of assets they own and what type of liabilities they have. I've fast forwarded, or I've done a search for life insurance assets. You can see that right here for JP Morgan, the largest bank in the world, the largest national bank we have in our country, currently is sitting on 6.6, and these are in thousands. So that's 6.6 billion plus another 5.6 billion. So that is what, 12.2, almost $12.3 billion of cash value life insurance. Bank of America, number 2 in our country, has roughly 20, we'll call that 21, $25 billion of cash value life insurance. And then we go to Wells Fargo. Wells Fargo has 5.6, 12.1, that's 17.7. So they have roughly $18 billion. So between the three of them, just the top three, what did I say? 18, 25, that's 40, 18 and 25 is 43. Plus another 13. So they have roughly $57 billion of cash value life insurance on their balance sheet, but you're being told it's a bad investment, okay? Think of this if you're a business owner. Think of this if you're an entrepreneur. Think of this if you also have employees that you want to think about retaining. This article came out in September of 2023, and it talks about, should banks own life insurance? And so this is called bank-owned life insurance, and I want you to change the B to a C and call it corporate-owned life insurance or company-owned life insurance. And I've highlighted a couple things, and I'll put the links to these articles in the comment section, or excuse me, in the description section of this video. So if you want to go directly to the links of this, I'll put that in there. Make sure you check that out. Including familiar financial institutions, one of the favorite assets to own is what's called bank-owned life insurance or corporate-owned life insurance. And it is a permanent life insurance that banks, and we can interchange banks for companies, may purchase on the lives of their executives, board members, other individuals in which the bank or the company might have insurable interest. The bank or the company is the policy owner and the beneficiary of the policy. The insured life is, as mentioned above, generally an employee, executive, board member of the bank, and banks therefore have direct financial control. So the Department of Treasury, the Office of the Department of Treasury, the Comptroller of Currency, stated that banks can purchase bank-owned life insurance in connection with employee compensation and benefit plans, key person insurance, insurance to recover the cost to providing pre- and post-tax employee benefits, insurance on borrowers, and insurance taken out on securities for loans. But let's exchange that from bank-owned to company-owned. Companies can purchase life insurance, corporate-owned or company-owned life insurance in connection with employee compensation, benefit plans, key person insurance, insurance to recover the cost of providing pre- and post-tax employee benefits. Why aren't you doing this? Why isn't your financial advisor talking to you about this? Again, the largest financial institutions in our country are devouring this by the billions and billions of dollars, but yet you're being told it's not good enough for you, right? It's how is that possible? Bank-owned life insurance, look in the green, bank-owned life insurance or corporate-owned life insurance, company-owned life insurance allows for tax-free growth in cash value if that held until the employee dies. Death benefits are generally tax-free under the Internal Revenue Code. Yeah, that's what I've been telling you guys. Look, and we go further down. the relative tax treatment of life insurance, tax-free growth on interest and dividends, tax-free use of the cash value, tax-free policy loans, tax-free retirement income, income tax-free death benefit, estate tax-free death benefit. This is a report for banks to determine the viability by a law firm a journal, benefits law journal. It's good enough for the banks, but it's not good enough for you. Doesn't make any sense. So let me go to the follow-up article. This was a two-part article. So this one came out in January of 2024. The other one was written in September of 2023. And again, the links will be to this in the description section. But according to the FDIC, think about this. According to the FDIC, among banks, then there's 4,100 commercial banks in the country, 4,100. With banks less than $100 million of approximate assets, with less than 100 million of assets, approximately 40% of those banks utilize life insurance as an employee benefit or investment strategy. 40%. You think that's a big number, right? 40%. However, among banks with assets equal to or greater than 250 million, so the biggest of the biggest banks, this percentage is anywhere between 70 to 80% utilize bank-owned life insurance as an employee benefit funding or investment strategy. But again, your financial advisor telling you it's not good enough for you. Life insurance sucks. It's expensive. It doesn't work. My investments are better. My rate of returns are better. My this is better. It's expensive. Don't worry about that. Pay my 1% fee. How is it that the best financial institutions in our country, the largest financial institutions, 70 to 80% of them are utilizing this as a tool, but you're not, because your person is telling you not to? Something doesn't make sense at all. And remember, compensation drives behavior. So you need to really think about where this is at. Why are they telling you not to do it? Maybe they don't understand it. Remember, I have a video. We can do this one. Most insurance agents and financial advisors are lazy, ignorant, or greedy, if not all three. So why do banks buy BOLI, bank-owned life insurance? And remember, bank-owned can be changed for corporate-owned, company-owned life insurance. As with any other employer, banks may have ongoing future cost of employee benefits and liabilities for both their general employee population as well as their executives and directors. Yeah, every business owner faces that. The main BOLI or corporate owned or company owned life insurance positives, it's an effective investment to offset the rising cost of employee benefits. Check. Consistent and competitive tax preferred yields from high credit quality insurance companies. Check. Tax deferred buildup of cash value as the policies grow, assuming the bank doesn't surrender. Check. Or the company doesn't surrender. The bank receives the net life insurance proceeds tax free. Check. The enhanced ability to offer competitive compensation plans. Check. Who doesn't want that? Banks can use a portion of the proceeds it receives as a beneficiary of the life insurance contract to provide a pre-retirement benefit to the insured. Yeah, who wouldn't want a pre-retirement death benefit to the insured, right? I mean, potential improvement to the bank's or the company's earnings in the balance sheet, diversification to the bank or the company's asset portfolio, key person protection for your executives or your key people, the bank or the company's VIPs. It's an accretive asset from the inception. It starts earning interest from the inception. I mean, I can go on and on and on about the positives of this, but the bottom line is, and remember, I told you that of our top 3 financial institutions in our country, they are using 70 to 80% of the largest institutions are using life insurance, cash value life insurance, as an enhancement to their executive benefits package, employee retention package, tax-free distributions, synthetic equity types of designs. And remember, these are the key characteristics: tax-deferred growth, tax-free distribution, high contribution limits, competitive returns. I did a video last time on competitive returns. You can check that out here. The living benefits, the long-term care benefits, it can be used as collateral. It's safe. It's got guarantees to it. But yet you're being told this is not a good asset for you. I really want you to question why that is. And remember, not all life insurance is created equal. So there is a proper way to structure this to get the maximum cash value of accumulation, minimum death benefit, control those fees and expenses. I did another video on comparing the 1% management fee plus the tax to a life insurance policy that's properly structured, and how the life insurance policy demolishes, is significantly less expensive over time than that 1% management fee and the capital gains and ordinary income taxes you would pay on your investment portfolio. But what do I know? I'm just a life insurance guy. And your financial guy is significantly smarter than me because he's got a bunch of numbers or letters behind his name. But yet, I want you to question where the information is coming from. I want you to question why. Compensation drives behavior. If you found this helpful, please like, comment, share, subscribe. Let's dig into a conversation. Check those links out in the description of the video, and I'll see you in the next one. Peace.